Hello, fellow Rebel Capitals. Hope you're well. So we have new jobs data. The ADP report came out today. And it's actually hard to believe. It's that bad. In fact, according to Zero Hedge, we haven't seen numbers this bad since the cerveza sickness. So let's get right into it and try to figure out what on earth is going on. Zero Hedge said it was a 5 sigma miss. I mean, this is huge. I wonder if they've ever missed by this much as far as what the actual number is relative to expectations. But just the short and sweet of it, guys, let's get to the calendar. Where are we here? So the market was expecting 100,000 jobs created, and it got a negative 33,000. And oh, by the way, last month's numbers were revised down to 29,000. Holy cow. But don't you worry. The economy is strong and resilient. And Jerome Powell, are you listening, buddy? You sure our biggest risk is with inflation and not the labor market? I don't know. Maybe he's second guessing that. But let's go over to Zero Hedge. They have a thorough analysis here. And let me see if I can make this a little bit bigger so you guys can see. Zoom in. There we go. I don't know why Zero Hedge. Whoa. Oh, that's big enough. Okay. So ADP reports biggest drop in service provider jobs. So, and that's really important too, because it's not like this number was just atrocious. It was the way it was atrocious, in that the big gain for jobs has been the service sector, right? I mean, the last 4 years. And everyone, when you talk about the manufacturing jobs, the ISM or the manufacturing in the United States, they're always like, oh, that number doesn't matter. The manufacturing doesn't even matter. I'm not talking about the MAGA folks. I'm just talking about like the economists. Those numbers don't even matter because it's such a small percentage of the overall economy. Okay. Their point is the only thing that matters are really the service jobs. Okay, well, now we're not only seeing the service jobs come in poorly, but we're seeing the service jobs come in even worse than all the other jobs. So they're leading things to the downside here. So then Zero Hedge points out headline print negative 33,000 and a downwardly revised 29 in May, 29,000. I think, what was the headline there? We'll have to look. I think the headline might have been 39. But here you go. So this is just the overall report. And this is not the service, which is even more important. But you see, we haven't had a number this bad going back to March of 2023, when we were probably, no, I don't think we're in lockdowns then. So I think it's the service component of this that's as bad as we saw during the cerveza sickness, which in and of itself says a lot, right? I mean, that's when the the service sector employment was hit the hardest, when we had the lockdowns and the government locked everyone in a cage. So the ADP employment change, here's a chart showing this 5 sigma miss from expectations. Again, expectations at 100,000, and it only comes in 133,000 short. Jeez. All right, what is this chart? And biggest miss since August of 2022. And this is the third monthly miss in a row. And you see why now. In the title, I said it's almost hard to believe, because yesterday we got the JOLTS numbers, and there were more job openings than expected. Remember, 7.8 million. And you look at the non-farm payroll last month, and I mean, it wasn't great. What was it, 139? A little higher than expectations. That's definitely a slowing economy or a stuck in the mud economy, but it might not necessarily mean that it's a quote unquote recession as defined by the NBER. But then remember when you looked at the household survey, it was negative 700,000 jobs. And the only reason the unemployment rate stayed the same is because the labor force participation just tanked. And so I don't know. I mean, it's like half and half. It's like half of the data we're getting in the jobs market is just horrible. Would definitely imply recessionary conditions, let's say. And then the other half that we're getting is like, well, it's not even the other half. It's really just the non-farm payroll. If I'm trying to go back through memory, I think the non-farm payroll really is the only outlier. And it's not like those numbers are great. Those numbers are just kind of not horrific. They're not negative. I mean, we'll put it that way. But who knows what happens tomorrow? Or maybe tomorrow you get a blowout number to where you have this massive discrepancy between the household figures and the ADP report. I mean, now I'm really curious to see what we get tomorrow morning. I believe around 8:30 Eastern time. That's when the report comes out. So this chart, I believe, just shows that we've had lower than expectation, or the expectation, the actual number has been lower than expectations for 3 months in a row. But it's not a great track record going back to, call it June or August of 2023. I mean, I'm just eyeing this up here, but it looks like at least 85% of the numbers have missed on the downside. But it's not like they've been negative, for heaven's sakes. That's what's just so eye-popping about this one. Negative 33,000. And remember what I was saying? I wonder if that's the biggest miss that we've had. It's the biggest miss we've had going back to, call it August or so of 2022. So basically going back to the cerveza sickness. Though layoffs continue to be rare, hesitancy to hire and a reluctance to replace departing workers led to job losses last month. Nella Richardson, chief economist at ADP. This makes a lot of sense based on what I'm hearing. I talked to a lot of guys in the entrepreneurial space and the marketing space, and some guys with literally thousands of employees. And every single one of them I talked to is like, well, we're just allowing people to quit and we're kind of trying to prod them in that direction. And then we're just not rehiring. And honestly, a lot of it's due to the economy, but a lot of it is also due to AI. And I think we're going to touch on that here in a moment. And oh, by the way, just before I forget, I know Microsoft announced another 9,000 layoffs today. Let me just make sure. Let me fact check myself here. I'm almost positive it was 9,000. Yeah, there you go. Microsoft is laying off as many as 9,000 employees, and that was just today. Just today. And this is, as CNBC points out here, that's just their latest round of layoffs. So they're not even waiting for people to quit. They're just giving them the pink slip. Let's get back to Zero Hedge. Okay, so ADP, this is a chart of private non-farm payrolls, net change in good producing industries. Okay, so now we're trying to see what's the difference between the goods and the service jobs, service providing industries. Looks like we had a negative 66,000. Yeah. So we had a negative 66,000 in service, which again is huge. I mean, if you're going to have a negative number and you were looking at this strictly through the lens of GDP and strictly through the lens of like a recession or economic slowdown, you would want the opposite. You would want the addition of jobs to be in the service sector, not necessarily in the goods producing. But look at that service sector down by 66,000. So change by establishment size. This is really interesting. Mid-size was the only one that had a gain. And there you go. The biggest one hit was small businesses. I mean, no surprise there. They're always the one that takes it on the chin. Excuse me. Large was the best. And again, that's no surprise either. That the large companies are always the ones that do the best. They're the essential workers. Remember that? The essential employers, the essential businesses back during the cerveza sickness. But they're always the ones that are going to do better because unfortunately we really don't have free market capitalism. We have crony capitalism. So, and that's where the small and mid-sized businesses are the ones that get disproportionately hurt. Unfortunately, they're the biggest job creators in the economy. Well, that's not unfortunate, but it's unfortunate from the standpoint of they're the ones that are always getting hit on the chin, but they're the ones that are really responsible. They're the ones that are the engine of growth in the US economy. So we've got the goods, natural resources, mining. That's actually not surprising with oil and gold. Manufacturing. Hey, good on Trump. Maybe, maybe those tariffs. Maybe I'm wrong about the tariffs. It's kind of a joke. Services. Oh, but look at this. So trade transportation is up, which is really weird because FedEx just came out and announced that they're not going to give guidance, which is never, ever, ever a good sign. But look at this. We've got financial activities, professional and business services, education and health. I don't know about education and health, but you look at financial activities, professional and business services. To me, that screams AI. That screams AI. And if it is, let's just assume for a moment that hypothesis is correct. I can assure you that this is going to get way, way worse before it gets better. So, leisurely hospitality. Okay, that's always up. So now they're getting into the year over year pay growth, which looks like it ticked down slightly. No surprise there. Rate cut expectations. Ha ha ha. So, if you guys have been watching my videos over the last couple of days, I've been talking about the dollar and how we've seen this big move down. And then I've been also talking about how I've kind of set up my portfolio, or one of the things that I've done, one of the bets that I've taken, one of the trades that I've put on, not necessarily a directional trade on the dollar, but what the dollar is telling me about what the Fed's going to do for the rest of this year and how that's going to impact interest rates. And so we're calling it the dollar playbook, and it's free. If you want it, Josh, you can put up the URL or the link. Put it in the description. People can click on it. And by the way, if you clicked on it yesterday, we had a little issue with the email provider. You just click on it, and you should be getting the email today, which is just the free video that I did explaining in detail kind of my rationale behind putting on what I think is a very asymmetric trade, by the way. Not investing advice. I'm just sharing with you guys what I'm doing. So you should get that email today, but we got things fixed. So if you put in your email address, you'll get an email. You click on it, you can watch that video. It's not edited or anything. It's just, it's pretty straightforward. But anyway, getting back to this and why I'm coming full circle here is what the dollar is telling me is that the labor market likely slowing, and the market is predicting that the interest rate differential between the ECB and the Fed decreasing. And so what do we see right here based on this ADP report is rate cut expectations go straight up, which is no surprise, which means that I have not looked at the dollar today, but I'm guessing yeah, there you go. I was guessing it would have been down because this ADP number puts I don't think it skews the probabilities massively of the Fed cutting or pausing during their next meeting in July. or at the end of July, I should say. But so I don't know it would go dramatically negative, but it definitely had an impact. So you see it going up, up, up today, the DXY, and then as soon as this number came out, the ADP, pew, and then since then it's kind of had some volatility. People are trying to figure out what was going on, and then everyone's been leaning more towards the probabilities of the Fed in or cutting rates going up. Although I'm not saying that it's like 90-10, it's still probably only 70% pause, 30%. In fact, let's check it out. So that was yesterday. Let me refresh. Yeah, so it went down. It definitely went down as far as the probability that they'll pause, and the probability they'll cut went up. And obviously, it's due to this ADP report. But I think overall, that's what you've seen in the slide of the dollar. It's not really people dumping dollars or having to dump dollars or giving Trump the finger or anything like that. It's more so just people betting that the interest rate differential is going to compress between the Fed and the ECB. Okay, let's get back to focusing on the jobs here. Let's get back to zero hedge. Okay, so that's it. You know what? I haven't looked. Let's go to the Wall Street Journal. Usually they have something that's pretty insightful over there. I'm actually really surprised this isn't front page of the Wall Street Journal. I mean, they've got something about P Diddy on the front page, but they don't have anything about the ADP jobs numbers just absolutely tanking. Like what do we do? Come on, Wall Street Journal. What are you doing? Here we go. So ADP report is soft. Soft? What? I guess that's one way you could describe it. How about catastrophic? Geez, soft. Yeah, all right. Okay. And then they don't even get into it. Thanks for nothing, Wall Street Journal. But I'm sure if I clicked on this one about P Diddy, and his sex trafficking, they'd have like some in-depth behind the scenes charts, graphs, everything that you need to know. Well, there you go, guys. That's really teeing things up for tomorrow. That it could get spicy. That's for sure. It's either going to be like the biggest head scratcher of all times if the establishment number comes out at like plus 2,000, something like that, or 200,000. I'm sorry. Or it's going to be like, yikes. It's either going to be a head scratcher or it's going to be yikes. I mean, man, can you imagine if the number comes out negative tomorrow? Then it's I think you would see that probability of the Fed cutting rates in July. That would probably go from, call it whatever it is now, 25% or something. I mean, I'll bet you'd go straight to 50%. And if that happens, guys, going back to that my dollar playbook, if that happens, then guess who's going to come out smelling like roses on that one? That would be this guy right here. This guy. Why would I come out smelling like roses? Because most likely the spread between the 2-year and the 10-year would really start to increase. I don't think blow out. It would definitely start to increase. In fact, let's look at that real quick here. We've got the 10-year up by 6 basis points today. What's happening, guys? The 2-year only up 1.6. Oh, here we go. The spread is getting wider. Oh, all right. That's all I'll say. I don't want to let the cat out of the bag. You guys got to go to rcp.georgegammon.com/dollar playbook. Submit your email address and you'll get the video and you can check it out for yourself. You can find out all these incredible strategies I'm using. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.